This is the Asia Trade. I'm Paul Allen in Sydney.
I'm Avril Hong in Singapore. Your top stories this hour. Asia set to extend cautious gains from Wall Street as traders assess the Trump administration's latest attack on the Fed and fresh threats of tariffs for countries trading with Iran. The grand jury investigation into Jay Powell stirring unease among some Republicans as the White House insists the order did not come from the president. Also ahead, the U.S. said to be closing in on a Taiwan trade deal with reports of a tariff cut in return for new TSMC chip plants.
And I'm Stephen Engel in Shanghai for the UBS Greater China Conference, where finance and business leaders are gathering to, of course, talk all kinds of subjects, including AI, geopolitics, and, of course, China. We'll be speaking exclusively about the bank's Asia strategy with Group CEO Sergio Ermotti.
This is the setup going into Asia markets today, with Trump amping up the pressure on Iran with those threats of fresh tariffs, along with these continued concerns about Fed independence. And it looks like the beneficiaries of this are Asia stocks. You see how futures point to the shrugging off, and perhaps also that helps the FX space. We are seeing dollar China already in the past day moving to the lowest level since 2023. We're watching Chinese stocks if the rally extends. Takaichi trade also in play today as Japan comes back from a long holiday, and that's something we're going to be tracking in the session as well, Paul.
Yeah, we saw some initial Sell America trades in the US in the early session, although it did claw back a little bit later on as the bond market tended to shrug off the potential for consequences of the DOJ subpoenaing the US Federal Reserve. Jay Powell, of course, pushing back pretty strongly on the narrative. And in terms of the Fed, we've just heard from the Federal Bank of New York President John Williams saying rates are well positioned to stabilize the labor market and bring inflation back to the central bank's 2% goals. So it looks like might not be any rate cuts coming anytime soon. And President Trump is facing rare opposition from key Republican lawmakers as federal prosecutors open that investigation into Fed Chair Jerome Powell. Fed and economy reporter Andy Curran joins us for more from Washington. So, and how much support or otherwise is there among Republicans for this probe?
Well, there's clearly been a pushback against this threat of a criminal indictment against the Fed, for sure, Paul. We have seen key lawmakers on the Hill come out with either statements or comments showing their concerns around this whole process. The most important one, though, so far remains Senator Tillis. He's on the Banking Committee, which is all important for confirming whoever takes over as the next Fed chair. And he's made it clear he's not willing to confirm anyone into that position until this whole legal process is sorted out, and he's not happy with these charges in the first instance. Now, it's a new development that, you know, President Trump has been attacking the Fed since he came back to office. That's old news. But what's new now is this pushback from the Hill, suggesting that perhaps there is something of a red line that may have been overstepped here. That's according to Fed watchers. And of course, the Fed themselves are pushing back forcefully in the way they haven't before this development as well. So lots of uncertainties as to how this plays out. But right here, right now, clearly the White House has a fight on their hands.
So to what extent are we seeing the pushback from the Hill actually perhaps causing the Trump administration to think twice on its attack and its pressure on the Fed?
Well, there's two versions on it. You have the version that the markets will embolden President Trump. You know, the relatively sanguine reaction from markets so far. There are those who say there's no off-ramp in this. You know, once the White House are gunning for it, they're not going to do a U-turn on it. That's one take on all of this, Avril. Of course, the other side is that because of the pushback from the Hill now, threatening to derail the confirmation process of whoever they nominate as the next Fed chair, and raising questions about existing Chair Powell's own future on the Fed board as well. And because there's a view that actually the market reaction isn't necessarily reflecting a green light for President Trump's actions, it's more reflecting an expectation on their part that ultimately this criminal indictment won't play out. Because of all of that, there is a view that, all of this remains very much up in the air. And it's not, I think the important thing we say about it is, speaking to a lot of people today, Avril, is no one's quite sure where it does go next from here. I mean, both sides are dug in now. The White House is dug in, the Fed is dug in. You can have your view on either side of that debate, but there's so much uncertainty up in the air now that it's hard to see where it goes over the months ahead, other than adding to uncertainty and confusion around the Fed and the Fed's critical role as a policy-making organ within the US economy.
Uncertainty indeed. And thanks very much, Bloomberg's Enda Curran. Now joining us is Nancy Davis, founder and CIO of Quadratic Capital Management. Now, Nancy, we are seeing the intraday moves, Treasury losses pretty much stemmed, and the extent in which we're seeing the 10-year 4.2% handle able to defend that. I wonder, given the backdrop, what is your sense of the potential for escalation and what that might mean on the upward pressure on yields? What are the risks here?
Well, definitely we saw a bit of a movement, an unwind, really from what happened on Friday. It was kind of a follow through of unwinding. The mortgage basis really tightened on the Freddie and Fannie news, and today it widened a little bit. But overall, markets are pretty, shrugging this off. These headlines about the investigation. Volatility didn't spike higher today. It was kind of a bit of a yawn in the markets. Actually, implied vol in the rate market is at the first percentile right now, really since the last 2-3 years. So even before Silicon Valley Bank in 2023, when we did see a vol spike in interest rate vols, they've fallen almost 50% since then. So interest rate volatility is very, very cheaply priced, and it didn't go up today. So I think the markets are not too concerned about the headlines. And are really pretty wait and see still.
That's one way of looking at it, but as our colleague Enda highlighted, it could also be the expectation that there's pushback and maybe this doesn't play out the way that the Trump administration expects. How would you then position in that event? What do you make of that argument?
Yeah, I think the yield curve steepener is a pretty nice way to play it either way, because right now the U.S. yield curve, if you look at the 2s, 10s, SOFR curve on your Bloomberg terminal, you can see it's only about 44 basis points today. So it's much cheaper than the U.S. Treasury 2s, 10s curve. And I think whether we have the Fed cutting rates in the future, or if we have the back end normalizing, the U.S. does have one of the flattest yield curves globally still, even at these levels. So it seems like a kind of good opportunity either way.
Yeah, Nancy, let's talk a little bit about the rate cut picture, because we just heard from the Fed Chair Williams in New York saying that rates are in a pretty good place at the moment. JP Morgan now sees no cuts in 2026. Do you think that's a realistic scenario?
I mean, it's definitely realistic. It's very hard to say kind of what the Fed is actually going to do. I mean, think about how many times the market expectations have been wrong on what the Fed is going to do. I mean, even going into 2024, the market was expecting 6 cuts from the Fed, and those didn't materialize. So the market is often wrong. I think the thing that is interesting in the markets is the cost of sort of having that binary outcome, whether the Fed's going to cut rates, whether the term premium is going to steepen, whether there's going to be a higher inflation expectation. It's really cheaply priced in the U.S. So I think having the either way is a pretty attractive trade with the yield curve steepener right now.
Well, we did see in the U.S. session today the Sell America theme made a brief comeback, but in this febrile environment where there's so much political uncertainty, concerns about Fed independence as well, what do you prefer? You say the U.S. is cheap, or do you look elsewhere to some more stable markets at the moment?
Well, yeah, just to clarify, I mean, the cost of owning optionality in the United States is cheap. So the cost of owning interest rate volatility is very low because the markets are not pricing in kind of any sort of fear or concerns right now. So whether you think the Fed is going to not cut rates, the yield curve steepener is, I think, a nice way to play that because it is cheaper than other markets, other developed countries around the world at currently 44 basis points on your Bloomberg terminal. So I think it's a nice way to express the view about, look, we don't really know whether the Fed is going to be, what they're going to do, what the composition is going to look like, how things are going to play out. And there's so many different, things at work, whether it's, geopolitics or developed markets hiking rates and kind of fighting inflation. But if you look at the, even the 10-year break-even curve in the U.S., it's currently 2.29. So the market isn't really priced for anything dramatic to happen. And I think it's a good time to add protection in the United States because you don't really know how things are going to play out.
Yeah, I mean, to your point, you alluded to some of this earlier, whether you see the levels of volatility as appropriate. How confident would you say you are, of risk for the rest of the year?
Well, I think because the price of volatility is so incredibly low, whether you're directionally bullish or bearish, either way, using options, options go into pricing. All of the cost of optionality is based on the level of implied vol. So an implied vol is really low, which it is right now, especially in the U.S. interest rate markets. Having that either way, whether you're bullish or bearish bonds, whether you think the yield curve is going to, steepen or not, there are a lot of really interesting opportunities because the price of owning that optionality is super low because nobody is really concerned right now.
All right, Nancy Davis, founder and CIO of Quadratic Capital Management. Thanks so much for joining us today. Well, President Trump says the U.S. will impose a 25% tariff on countries doing business with Iran, ratcheting up the pressure on the government in Tehran. Iran's foreign minister earlier said security forces had full control of the country amid reports that the U.S. military is weighing intervention. Let's get to Washington now and Bloomberg Balance of Power co-anchor Joe Matthews. So, Joe, tell us about the latest on the ground. What do we know and what options is the Trump administration weighing here?
Well, it does seem like there might be some improvement on the ground, at least according to Iran's foreign minister, who says they have full control, that security forces have regained control of the country after more than 2 weeks of violent protests. It's been remarkable looking at not only the scale of the protests, but the duration in which they have lasted. Going into a third week here is remarkable and one that has clearly gotten the president's attention. We've heard a lot of rhetoric here from Donald Trump. Most recently, to your point, this 25% tariff that was just a short time ago via Truth social media here in the United States. But tomorrow's going to be a very important day in this whole process as the president is briefed by the chairman of the Joint Chiefs of Staff and others, including his defense secretary and Secretary of State Marco Rubio, on what they're calling a menu of options here. And what the president says are some very strong options. They do include military options. We could be talking about another round of strikes, remembering, of course, that the United States did strike Iran and its nuclear processing facilities last year. But they could also include cyber. They could also include diplomatic measures. And the president says he'll be making a decision imminently.
What about what we're seeing in terms of the impact from these potential additional tariffs and the way in which it might ring-fence the Iranian economy that's already suffering from the weight of sanctions?
Yeah, well, you have to remember, of course, that there's not a lot of trade going on with Iran around the world. It's really China and Russia that we're talking about here, and that's likely motivating the president to an extent as he tries to manage relations with those two countries, including a hot war with regard to Ukraine when it comes to Russia. I'm not sure the president sees these tariffs going into place. He says, by the way, that Iran made a phone call. He says that they called him to negotiate. And that could be the next leg in this story. He said, we'll hit them at levels they've never seen before, but they want to negotiate. And it is a conversation that he's interested in having here. We don't expect a final decision, by the way, following that briefing or in that briefing that he receives tomorrow. But the president said that he will not take long to make up his mind.
Joe, to what degree is some caution warranted here? Because overt U.S. involvement, could that potentially work in the regime's favor?
Well, look, that's always potentially the case, but we heard that before the United States struck Iran last year as well, and it's been something that's been relatively contained, relatively well contained. I'm also curious to know about what involvement the Israelis might have in a strike like that, if in fact we are talking about strikes, knowing that we've already badly damaged their nuclear capabilities. The president will have some very delicate decisions to weigh when it comes to what additional targets might be involved here that not only impact the regime, but play in favor of these anti-government protesters. And that's a delicate line for him to walk.
Joe, thanks very much. Our Balance of Power co-anchor Joe Matthew in Washington with the latest on the U.S. options on Iran. Coming up on the Asia Trade, we'll take you live to the UBS Greater China Conference in Shanghai, speaking exclusively with their senior China economist and Group CEO Sergio Ermotti. Much more ahead. This is Bloomberg. Here's the setup for Japan assets as the country comes back from a long weekend with the Takaichi trade potentially in play as speculation is rife that she could be calling a snap election. This is what we're seeing on Nikkei futures, moving sideways a bit. Let's get a preview, though, of the market open in Japan with our stocks reporter Alice French. So Alice, we were talking about some of this yesterday, right? How the Takaichi trade might be in play today, but since then we've been seeing pressure on the Fed, Iran developments as well. What are you expecting when trading begins?
Well, I'm definitely expecting a busy day here in Tokyo. As you say, of course, all of those international factors likely to come into play. We have, of course, the Fed probe causing a lot of concern, and also, of course, rising issues with Iran too, and we'll see how that plays out here. But domestically, right, over the weekend, we had this growing speculation of a potential snap election that could be happening as soon as next month, local media say, and that's expected that if it happens, it would strengthen Takaichi's position in Parliament. We know the ruling LDP right now, of course, in a minority in both houses. But that hasn't stopped Takaichi from introducing, the biggest fiscal spending package since COVID that's already pushed up a lot of sectors of the market, including defense, tech, nuclear power, all of these areas that she wants to strengthen and sort of make Japan great again. That's helped bring the Nikkei and topics up to new highs in recent weeks. And so it'll be interesting. We may see a revival of that Takaichi trade today. We know that, of course, the yen weakened over the weekend. That could help exporters. So we'll see how all of these different factors sort of interplay this morning.
Of course, calling a snap election is somewhat of a gamble. It might work to Takaichi's favour and maybe not. So longer term, how could this impact assets?
Well, that's the big question, right? Of course, if the LDP does come out of this potential election with more gains, which a lot of people are expecting because Takaichi's approval ratings are pretty high right now, then that's going to be a plus for the market. Not only will it bring sort of more political clarity and stability, but like I say, it would also potentially allow Takaichi to sort of strengthen her fiscal expansionary stance, which is good news for equities. At the same time, though, we know that her sort of aggressive fiscal stance has weighed on the bond market. There's people expecting that we might see bond yields climbing today on that, and that, of course, will sort of encourage the kind of the concerns around the Takaichi trade and, of course, weigh on the yen. Like you say, if in a potential election the LDP were to underperform expectations, though, that's only going to throw things into even more disarray than they are right now. Like I say, the LDP already in a minority, and sort of any more political uncertainty and lack of clarity, particularly at a time when things are so complicated internationally and Takaichi is having to sort of navigate that relationship with Trump, would only serve to weigh, I think, on Japanese equities, but also assets as a whole.
You talk about these upward pressures on yields. That's played out in the bank-related stocks as well. Talk to us about the specific sectors that you see benefiting.
Yes, of course, like I say, financials are one, and of course we know that they've also gained on those BOJ rate hikes. But defense is another big one that Takaichi has spoken about. She wants to pump more spending into nuclear power, things like quantum computing, tech and AI, of course, are things that have benefited from her stance too. But she does come with downsides as well. You know, we know that her recent comments on Taiwan have sort of triggered this bilateral spat with China that's still going on kind of 2 months later, and has now resulted in these kind of export curbs on those dual-use items, which we already saw weigh on some kind of chip stocks and auto stocks last week. So Takaichi definitely comes with kind of upsides and downsides for the market. It'll be interesting to see them kind of play out today, and I don't know which one will win yet. We'll be watching closely.
Alice, we're just getting some breaking news here, some lines from Japan's Finance Minister Satsuki Katayama speaking in Washington, holding bilateral talks with U.S. Treasury Secretary Scott Bessent, saying, Katayama saying, I am concerned about one-way yen moves. We've seen plenty of those. Also mentioning that they're bolstering supply chains for critical minerals, and that's key. But in terms of one-way yen moves, I mean, we've got the yen briefly touched a moment ago, 158, Alice. How likely is it that we see intervention in the coming days?
Look, there's been a lot of talk of potential intervention over the last week here, and like I say, the yen down at sort of its weakest position against the dollar since last January. Of course, intervention looking increasingly likely, and even more so with those Katayama comments. Of course, you know, this only feeds into the anxiety, right? Of course, a weak yen potentially good for exporters' stocks, but overall it kind of feeds into this potential, I suppose, sell Japan movement that we sort of saw coming up before Takaichi announced her fiscal expansionary package a couple of weeks ago. So, yeah, I mean, I don't know. We could be moving towards that intervention level. And like I say, that's only going to kind of feed into the anxiety that's building up both domestically and internationally today in the market across assets.
Japan stocks reporter Alice French there. We have more ahead on the Asia trade. This is Bloomberg.
Major employers have seen the value of working in person. We're seeing quite a shift back into bringing people back into New York City, working together, and that's, I think, supports the local economy. The other thing I would say is that what our local economy is also changing. Obviously, technology firms, technology businesses are playing a much bigger role.
You're watching live pictures there for the New York Fed President John Williams speaking at an event in New York City. Now, he previously talked about how inflation is likely to peak in the first half of the year, and that, you know, there's no sign of a rapid deterioration in the labor market. But perhaps most interestingly, another voice throwing support for Chair Jay Powell amid this criminal probe that's been opened into him, talking about how the Fed chair is a man of impeccable integrity. Paul.
Let's get the latest from the corporate front. Trafigura and Vitol are planning to move 4.8 million barrels of Venezuelan crude to storage in the Caribbean. The oil is part of a U.S. orchestrated sale of up to 50 million barrels after the Trump administration seized control of Venezuela's supply. Documents seen by Bloomberg show the crude is already loaded on 4 tankers off Venezuela. NVIDIA plans to invest $1 billion over 5 years in a new laboratory with drug maker Eli Lilly. It says the Silicon Valley facility will combine Lilly's lab expertise with AI innovation, automating research processes and enabling software to handle human tasks. It's the latest example of NVIDIA using its newfound financial might to cultivate fresh markets for its products. We have more ahead on the Asia trade. This is Bloomberg. Some breaking news out of Australia. It is consumer confidence numbers for the month of January, and it's a lack of confidence, really. A 1.7% decline in what we saw from December, a reading of 92.9. So we're back firmly in pessimistic territory in terms of consumer confidence in Australia after a brief bout of optimism back in November. So that index back in negative territory. Although, interestingly, Avril, even though the expectation is that the RBA easing cycle is done, intention to buy a dwelling actually increased while the rest of the index was softer.
Meantime, Paul, let's take a look at how other currencies are faring against the greenback, given the slide in the past session and those concerns about Fed independence. Now, we are seeing, after the dollar trying to climb lower in the past day, there seems to be a nudge upward back towards the 7 handle, given these developments related to Iran, those threats of tariffs. We are also watching Katayama-san in terms of verbal intervention from the finance chief, talking about how when it comes to the yen, the weak yen, she shares the view of the Treasury Secretary, Scott Bessent, and they've been warning about these one-way yen moves. Now, the UBS Greater China Conference is getting underway today in Shanghai. Our Chief North Asia correspondent, Stephen Engel, is there and joins us now with our next guest. Steve?
All right, Avril, thanks so much. Yeah, we have a loaded plate today, the 26th annual Greater China Conference from UBS here at the Shangri-La Pudong Hotel in Lujiazui. And we are kicking off, we are setting the table of our coverage with Ning Zhang. He is UBS's senior China economist, setting the table for, of course, the interview in the next hour. Sure. Sergio Ermotti, the group CEO, will be joining us. So in your report in November, you essentially assessed 2026 would be a little bit of a pullback for the Chinese economy, a decline in net exports. The domestic consumption story is still fairly tepid. What is your more recent outlook for growth this year?
Thanks, Steve. Welcome to GCC.
Thanks.
So basically, we see a small deceleration of growth in China in this year to around 4.5% from last year, around 5%. So the deceleration is mainly due to the smaller growth contribution from net exports. We're still seeing some challenges from continued profit downturn, possibly slower exports, but the domestic resilience is still in place, like the cyclical rebound of the investment and modest but softer consumption growth. And eventually, people are looking at very closely at rebalancing themes in China, which means innovation, anti-evolution, opening up, and also try to boosting consumption in the longer term.
So also this year will not necessarily be the year of great stimulus, fiscal or monetarily, right? It's sort of a readjustment period?
Yeah. It's kind of moderately supportive, but more balanced support from the government. For example, the fiscal deficit may stay unchanged at 4%, but there's some greater issuance of special bonds, and also there's some readjustment of the trade-in subsidies. But meanwhile, we still see PBOC can cut interest rate by maybe 20 BPs.
So if net exports are going to be declining a little bit and GDP is about 4.5%, where are we going to get the contributions to basically hold up the growth? Because the 15th five-year plan essentially names consumption as the main goal, but will it be a main driver?
We are seeing two things here. Of course, first one is cyclical rebound of investment, for example, in infrastructure per se. The other one is long-term per se. We are seeing more positive on consumption. But in the near term, we're still seeing some challenges on consumption growth because of the trade-in subsidies diminishing, and also there's some lingering headwind from the housing price decline. But more importantly here, we're seeing rising power of the innovation and the new economy sectors.
Which is interesting because AI and other areas of the new economy contributed, I guess, from your report and your estimates, between, 15 to 20% of GDP. That's quite sizable. In an industry, AI alone is not profitable.
Yeah, exactly. So the 15 to 20% contribution, that's more than AI. That's a broadly defined innovation and new economy sectors. We're seeing more R&D spending, more commitment from the government should push up the further contribution from new economy sectors in the next 5 years, maybe by another 3 to 5% points.
Really? So in the next 3 to 5 years, you have 3 to 5% increase?
Yes, exactly.
Okay. So anti-involution campaign has been ongoing in areas like solar and in EVs and in batteries. But we've also seen a slew of startups in the AI space, Minimax and others, raise money in Hong Kong, but they're not profitable. And there's no real horizon for profitability in these large language models. So how does the anti-involution campaign impact that so these new startups in the AI space can be profitable and contribute greater to growth?
Eventually, we need to see the AI play to generate profits. But now that's in the early stage of corporate capex and building your frontier in the future, and even for so-called self-sufficiency theme in China. That's why we believe China will focus on the balance between, how to develop the frontier sectors versus how to rebalance the supply-demand balance. And that's anti-evolution campaign theme, which means reviving inflation, reviving profitability, and eventually getting stronger and getting larger.
What is your outlook for inflation? It's ticked up slightly on CPI, but oftentimes it's food or cyclical nature. PPI also improved a little bit, but it's still in persistent 3+ years of deflation. Are we going to see an end to factory gate deflation this year, or is that going to be a long-term trend?
Bottom line here, we see CPI rebounding slightly to 0.4% and even more next year. PPI is narrowing decline in this year and possibly turning positive next year, which means we're not very far away from the overall inflation turning positive.
What role does the renminbi play? Because we've just seen the numbers. It's now appreciated past that 7 handle. What role will the authorities use the renminbi to maintain growth?
RMB, from the fundamental perspective, we're seeing RMB to appreciate versus the basket of currencies. But again, because our house view believe dollar may rebound a little bit in the second half of this year. That's why versus dollar, RMB may hover around 7.
All right. Ning, thanks so much for your time on Bloomberg Television. I appreciate it for kicking off our coverage of the 26th annual UBS Greater China Conference here in Shanghai.
Thank you, Steve.
All right, thanks a lot. We're going to send it back to you. Much more to come, including Sergio Ermotti coming up at 8 o'clock Shanghai time.
All right, Stephen Engel there in Shanghai. And as Steve mentioned, we do have much more ahead from the UBS Greater China Conference. Don't miss Steve's exclusive conversation with the group CEO, Sergio Ermotti. That is coming up in the next hour. Avril.
In the meantime, Paul, we're also watching developments related to tariffs. Bloomberg's been told that the Trump administration is closing in on a tariff agreement with Taiwan, with negotiations entering the final stages. Let's bring in Washington Deputy Bureau Chief Laura Davison. Laura, what are we hearing about the contours of this deal?
Yeah, so both U.S. and Taiwanese officials say they're in the final stages of this deal, which could be struck and announced later this month. The overall arching goal here for Taiwan is to reduce that tariff rate, which Trump set at 20%. The deal would move it down to 15% in exchange for TSMC pledging to build 5 new chip plants in Arizona. So this is really kind of hits 2 things that Trump has been very keen on. One, of using those tariff levels as leverage, and also getting commitments from large corporations to build new factories in the United States.
What was the involvement of TSMC in this tariff deal?
Yeah, so this is a really unusual, a deal here, in that you have both sort of the countries negotiating, over what these tariff rates could be and looking at trade flows, but also a specific company coming to the table and saying, look, as part of this deal, we will commit, on a corporate level to give this kind of investment that TSMC has brought to the fore here. This really shows, one, just how important the chip maker is to the overall Taiwanese economy and how important that selling into the U.S. market is to them. But this is a real kind of a hallmark of the Trump era, that you have, corporate actors sort of sitting at the table in addition to heads of state and head diplomats.
Hallmark of the Trump era is also the use of tariffs as a tool. What are the risks that the potential for the Supreme Court ruling upends what we see from a U.S.-Taiwan pact?
Yeah, so there's a lot of potential here for this deal to go sideways. We could hear from the Supreme Court as soon as Wednesday in the U.S., so really just 36 hours from now, that Trump's reciprocal tariff plan. So this is the tariffs that are on the country by country basis are not legal. The Supreme Court is set to rule on that. We are not sure what they will say, but if they strike down all of these tariffs, that means that the pact with Taiwan, as well as all of the other agreements that Trump has struck with various different countries countries would all be null and void. Those tariffs would have to be repaid to the importers that already paid some of those taxes, and it would really sort of reset Trump's whole trade agenda. The White House has said that they have other methods that they're looking to reimpose these taxes if they are struck down, but this will really, sort of upend, essentially almost a year of work and negotiation. So this is what the business community is cheering for, but of course the White House did not want to see that come to fruition.
All right, Bloomberg Politics editor and Washington, D.C. Deputy Bureau Chief Laura Davison there. The top global headlines that we're following. German Chancellor Friedrich Merz has met with India's Narendra Modi on his first trip to Asia since taking office, urging New Delhi to urgently conclude trade talks with the EU. Merz says the world should brace for more uncertainty with the return of what he calls global power politics. The two countries signed agreements covering areas such as critical minerals and traditional medicines.
We will work on a roadmap which will open up new opportunities for co-development and co-production. Today we discussed in detail several global and regional issues, including Ukraine and Gaza. India has always advocated for the peaceful resolution of all problems and disputes.
China is intensifying efforts to tax its citizens' vast undisclosed overseas assets as authorities attempt to plug a widening budget deficit. However, the crackdown remains patchy since the size of overseas investments is difficult to calculate. Local authorities are using big data to track down individuals and demanding that they self-declare any offshore income from 2022 to 2024. More ahead on the Asia trade. This is Bloomberg.
Now, we've been seeing the U.S. president really zeroing in on affordability issues in a midterm election year. We've been hearing about how he wants to cap some of these credit card charges, since hearing how he wants the data centers to be paying for electric bills, that a tech company should be bearing the brunt of this, and that utility bills, he highlights, for American households, they actually went up massively, according to him, over 30% in the Biden era. So certainly upping the concern and focus when it comes to affordability in the U.S. These comments coming through from Truth Social and the U.S. president. Paul?
Well, Paramount is ratcheting up the stakes in the month-long battle for Warner Brothers Discovery, saying it plans to nominate directors to the board to block a merger with Netflix. Let's bring in Chris Palmieri now, who leads Bloomberg's media and entertainment coverage. So, Chris, another development here. How does this change the maths on a potential Paramount-Warner Brothers tie-up?
Well, it's just another bit of pressure that Paramount is putting on the Warner Brothers board to try to get it to change its plan. As you noted, they're going to propose their own directors, either for the annual meeting or if there's a special election coming up. They've already launched a tender offer. The other news today was that Paramount sued Warner Brothers to try to get access to documents in their planning of this merger with Netflix. They really want to know exactly what they're valuing their cable networks at, which are being spun off to Warner Brothers shareholders, and that's a big difference between the Netflix bid and the Paramount proposal. So always a lot going on in this fight.
Any indication of how much longer this takeover saga might be dragging out for?
No, I get asked all the time, and I don't think David Zaslav of Warner Brothers, David Ellison at Paramount, or Ted Sarandos at Netflix really know the answer. It's a big game of chicken, and until one of them drops out, the fight goes on.
Chris, what are the chances that this ends up in a proxy battle at a shareholder meeting, and how might that play out?
I think it's going to be really difficult for Paramount to win. They've given early indication of how many shareholders had supported their tender offer, and it was a very low number, under 1%. That may have changed in the past few weeks. But to completely take over the Warner Brothers board and change the course of this deal, I think it's going to be difficult for them.
Chris, amid the noise surrounding the potential for a takeover and Netflix being involved in this battle, it's hard to forget the earnings for the streaming giant is coming up. What's your sense of what you're hearing from analysts in terms of will it be a strong finish for the Q4?
Yeah, I mean, Netflix had said all along last year that it was going to have a lot of shows coming out at the end of the year that were really strong, and that certainly seems to be the case. We saw them do very well at the Golden Globes last night. K-pop Demon Hunters, Adolescent really cleaned up. So, they've always been a little weaker in movies, which may explain this. Warner Brothers had a terrific night, for example, in movies at the Golden Globes. So you're really seeing that potential combination come to life there.
Chris, thanks so much. We'll continue watching this long, drawn-out battle for the company. Chris Palmieri, who leads Bloomberg's media and entertainment coverage. Now, we're watching stocks of major credit card providers in New York after they tumbled as the U.S. president called for a 10% cap on interest rates. And this comes just days after real estate investors were blindsided when Trump floated a ban on institutional buying of single-family homes. Let's get more and bring in Bloomberg Intelligence senior analyst Herman Chan. Herman, there is a lot of concern. I think the banks feel a bit blindsided as well by all this. But how might this even work? Is that something that might actually come to fruition?
Right. So we're ascribing a low probability for this to be implemented. Keep in mind that currently the annual percentage rates for credit cards is north of 20%. So we're talking about very draconian haircuts to the credit card business that would virtually make the credit card business unprofitable. So I think banks would really fight tooth and nail to really prevent this sort of 10% cap outcome. But a lot remains to be seen, and we'll hear more about it during the earnings calls this week for the big banks.
On the topic of earnings calls, we do have a number of big banks reporting next week. JP Morgan, Citi, Bank of America as well. What are we expecting to hear?
Yeah, we're expecting to hear a lot of strength across the businesses. So strong trading results on a year-over-year basis. Investment banking really ended the quarter well heading into 2016 with real optimism in terms of IPOs and equity and debt issuance. And then on the lending front, we expect to see some solid lending across commercial lending, commercial real estate, and cards. So both on the fee income side and on the trading income side should be really strong results. But really the crux of the earnings calls will be on guidance for 2016, and we'll hear more on margins, growth prospects, and also expenses, which could be a potential hiccup for the group.
What is your assessment of to what extent the earnings will support what we're seeing in valuations among these bank stocks that have gotten really pricey of late?
That's right. So we're at about a 1.6, 1.7 times adjusted tangible basis, which, as you suggest, is really on the higher end of the group over the past several years. And that really reflects a rotation into financials and banks in particular. I think the interest rate cuts and the steeper yield curve has helped lift valuations and sentiment for investors. But so that also creates a higher bar for earnings and for guidance. So the banks will have to clear this higher bar, given the fact that we are at definitely higher valuations for the group.
Herman, thanks so much. We'll be watching those earnings scorecards as they come in. Bloomberg Intelligence senior analyst Herman Chan for us. Now, we also have some breaking data out of Japan for the month of November. The current account balance shows us a surplus of 3.67 trillion yen. So this represents a widening from the prior reading. We also got the trade surplus at 625.3 billion yen. But in terms of market action today, of course, we're going to be watching how the Takaichi trade plays out, the expectations that this aggressive fiscal stance from the Prime Minister could continue fueling the pressure on the bond markets. Indeed, when you're looking at JGB futures, that is the direction that it's showing. More ahead on the Asia trade. This is Bloomberg. Breaking news crossing the terminal. We're hearing BlackRock, the world's largest asset manager, is cutting headcount, adding to the signs of yet another Wall Street firm that is pulling back on jobs numbers. We are seeing them cutting hundreds of jobs across the company, and the cuts would represent about 1% of their global headcount, according to sources speaking to Bloomberg. Now, we've also been seeing other job cuts across corporate America. Bloomberg has learned Citigroup is set to cut about 1,000 jobs this week as part of CEO Jane Fraser's push to control costs and boost returns. Sources say the lender is making the cuts as part of a plan to eliminate 20,000 jobs this year. Citi is also set to report full-year results on Wednesday, as well as informing staff of their bonuses for last year. Meantime, a source says Meta plans to cut 10% of its Reality Labs division as soon as this week. The move is part of a strategy to shift funding away from some virtual reality products and into other AI wearables. Reality Labs has about 15,000 employees and has been losing billions of dollars each quarter. Paul?
Time now for morning calls ahead of the Asia trading day. Money managers at PIMCO and PGIM say President Trump's attacks on the Fed's independence clash with his push to lower rates. PGIM says markets may grow skittish with lasting implications. For PIMCO's Daniel Iverson, the market reaction shows confidence that the law and the political process are strong enough to insulate the Fed from Trump's pressure. JP Morgan no longer expects the Fed to cut rates at all this year and instead sees a rate hike in 2027. The bank's strategists and economists say the December US jobs report eased concerns about a weakening labour market. They add that front-end premium may persist for several months, with markets reluctant to price out labour market risks and attention focused on the Fed share race. Avril.
When it comes to central bank action, I think that's something that's also figuring into the equation today. But of course, with Japan back from a long weekend, the concern about the extent in which a snap election might fuel further stimulus from the Takaichi administration, certainly that could put further pressure on the long end. When it comes to JGB futures, you're already seeing those declines, and the 30-year bond yield has risen 12 basis points to 3.52%. We are interestingly seeing dollar yen also looking fairly flat, actually clinching some gains against the greenback. But don't forget, it was sitting above this handle just a day ago, given the softness in the US dollar. Nikkei futures pointing to a pop at the open. We'll track how markets start trading. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens, and a couple of things at play here, Paul. We have Trump upping the pressure on Iran in terms of threats of 25% tariffs for countries that trade with a Middle Eastern nation. And on top of that, markets still grappling with the uncertainty surrounding this probe into the Federal Reserve and those concerns about how that might affect the Fed independence.
Yeah, we did have words of support from the Fed's John Williams a little bit earlier, describing Jay Powell as a man of impeccable character. JP Morgan, meanwhile, saying that they're not expecting to see any rate cuts at all this year, Avril.
Yeah, ahead of all that, let's take a look at how Japan is faring in the early goings. Of course, they're off a long weekend where we got word from local media that Takaichi might be mulling an early election, a snap election, to capitalize on a popularity. And certainly from opinion polls recently, that's what we've been seeing. We are seeing in the early goings Japan stocks just piling on to the gains of late. And the Nikkei is surging about 1.7%. So you can see that Takaichi trade, so-called, at play for the moment. We are also watching dollar yen. It was interesting that intraday yesterday, we actually saw the yen, despite the softness in the dollar, managing to clock slight gains, a bit of a reversal for the moment, moving towards the 158 handle. And we have the likes of Katayama saying that they are pretty much aligned when it comes to these one-sided moves, and that commentary coming through in conversation with the U.S. Treasury Secretary. Upward pressure expected still on JGB yield. Certainly, we've been tracking the 3.52% handle, so that's something that could be in play as well in the session. Take a look at South Korea. What's been interesting amid these concerns about Fed independence is how emerging markets seem to have been benefiting from a revival of the so-called Sell America trade. We are seeing in the early going, South Korea is adding on to those gains already, and it's the chip-related stocks that seem to be doing fairly well. Paul?
Let's take a look at what's happening in bond trading in Japan as well, because we saw, well, perhaps a shot across the bows from the bond market a little bit earlier regards Fed independence. The 10-year yield did tick up to 4.19. It's since pulled back a little to 4.17. There seems to be a bit of confidence in the market that the judicial and political environment in the U.S. is enough to keep the Fed independent. And I mentioned we heard from John Williams, New York Fed president. He called Jay Powell a man of impeccable character, but also hosed down expectations of easing this year, saying, well, rates are in a pretty good place when it comes to stabilizing the labor market and getting inflation back to target. Take a look at the gold price as well. That initially cracked 4,600. It's pulled back a little bit since then. Crude prices stabilizing just under $60 a barrel for New York crude. Well, let's get you straight back now to UBS Greater China Conference in Shanghai. Our Chief Asia correspondent, Stephen Engel, is there with our next guest. Steve.
Hey, thanks a lot, Paul. Yes, it's the 26th annual GCC here in Shanghai. We've been covering a lot of them, and we are very pleased to bring in the guest of honor. Not the guest, he's the host. I'm the guest here at the GCC, and that is Sergio Ermotti, UBS Group CEO. Thanks so much for having us here this again. What is your message to the 3,600 or thereabout participants here at the GCC this year, and what's your general outlook for business in China for your bank?
Well, actually, it's also great for me to be back here. Last year was a quite, important year for China. I think that we saw a huge interest coming back on the Chinese market. Stock performance was great, and we see it today. I mean, we have almost 3,600 participants. You go through across the board from corporates, institutional clients, family offices, and not coming from also all over the world. We see also more interest from overseas, which is indicating the momentum of the Chinese market. So I think that we believe this is going to continue. The secular trend supporting China in terms of growth in innovation, in technology, in biotech is here to stay, and investors are realizing that.
What kind of deal flow, though, are you starting to see as we are starting to see China get some momentum? You talked about the stock market, the CSI 300 up about 17% last year, so it's gaining some steam, but also outbound deal flow seems to be growing quite a bit, whether it's investing in factories in Europe or in the global South. It seems like capital is not only coming into China, where foreign interest is obviously looking at that rebound, but also the capital is moving abroad.
Yeah, I mean, look, it's a good mix of businesses, but when you look at, for example, the underweight of international investors to China, almost half, from around 2.5% in 2024 to 1.3% or so in 2025. So this is a significant change on a year-on-year basis, and this is the main driver. We continue to see a lot of activity around IPOs, particularly you saw the record IPO issues last year in Hong Kong, which are probably going to stay with us also in 2026. We see a lot of activity across Asia. Inbound and outbound M&A in Japan is up threefold. So in general, I would say that you will continue to see momentum of Chinese investors investing abroad, but also capital coming into the country.
What's going to be your priority onshore for 2026? Last year you got the full 100% securities license. What's going to be the priority?
We are working on all of this. We also last year we also made a capital increase in our local entities, and I think this year we are now planning to launch a Panda bond. So I think that we want to continue to foster our presence in China. We have been in China for mainland China for 35 years. We have been in Hong Kong for 60 years. So this is really part of our core business. I mean, if you think about, we are managing in the region more than $1 trillion of assets, 800 plus in wealth management and 215 in asset management. So we want to continue to reinforce that position, but at the same time, our leading position in the investment bank across the board, and where we are a leader in the region and in China, mainland China particularly, and also in asset management through our very successful joint venture with ICBC.
What can you tell us about the arranging of that Panda bond, the size and timing and the likes?
This is still to be determined, but the decision has been taken to issue a Panda bond.
So onshore versus Hong Kong or Greater China, what's going to be the emphasis onshore as far as hiring? I mean, you're very strong in wealth management, obviously, asset management. What's going to be the priority?
Well, look, this year I think that our goal is to continue to working with local universities, hiring young talents. We employ around 1,300 people in China. Half of them are in Shanghai, and the rest is in Beijing, and the rest of in Shenzhen. We probably going to add up around 100 people this year in China, and we are, as I said, we are also investing not only in seasoned professionals but also in the young generation of people for the franchise.
So obviously you still have some personnel issues on the cost reductions from the integration with Credit Suisse. That's separate from what you're going to plan to hire across Asia and in China.
Yeah, look, when I look at Asia in general, the integration is over, is done. So I think that we completed the integration in 2024. Mainly in Asia across the board. The investment bank has been closed and asset management the same. So as I just mentioned, we are hiring both in China, but broadly speaking also in Asia, in Japan, for example. We have been expanding our capabilities and leveraging really the complementarity of Credit Suisse and UBS together, where we not only have a broader footprint in terms of capabilities, but also of geographic footprint.
How would you assess how your businesses in Asia are doing versus other regions, whether it's Europe or the United States?
Asia has been growing, very fast in the last. It's probably the biggest engine of growth in nominal terms. Is accounting for around a quarter to 30% on average in the last 5 years of our profits. So as I mentioned, we manage more than $1 trillion of assets out of the $7 trillion we manage globally. So it's a growing, steady growing business, which when you look at the engine of growth is, GDP growth is definitely going to help. 4.5% in China is quite important, but it is a driver for growth in the entire region. We are selectively gaining some market shares in areas where we want to compete. And last but not least, this monetization, this IPO calendar is very important to our wealth management business, because this is really helping us to drive net new money, net new assets into our wealth management franchise.
Well, speaking of that IPO pipeline in Hong Kong, it's been quite strong. A lot of the new economy companies, but there are also concerns of the new economy companies, whether it's Minimax or others, that profitability, just like the AI companies in the United States and Western markets, that the sustainability is not necessarily, it doesn't have a lot of visibility. But what's your views on whether we're in a bubble and how long that potentially could still last?
I don't know if we are in a bubble or not, but of course, when you see this kind of multiples and performances, you have to ask yourself, is this a repeat of what we saw in maybe in another time?
2001?
Exactly, the TMT bubble and so on and so forth. I would say that in general, first of all, our advice is very clear. Diversification, no concentration of risk around the sector. the technology and is here to stay. But we should not really mix the two issues. From an investor standpoint of view, it's very important to diversify, not to get into a trap of trying to pick up the winner or the loser. But the truth of the matter is that the first wave was probably around the technology sector. Now we're going to see how embracing and implementing AI can help other parts of the economy become more vibrant and more efficient, and that's probably going to be also the next side of the story.
You also you can't discount the fact that most of the deal flows right now are in China. The interest is in these new economy companies. Yeah. So could you kind of quantify the type of deal flows, whether it's underwriting or other types of businesses or services from your bank that are tied directly to what has been a priority of central government policymakers here?
Well, look, but this is something that is not really new. I mean, the priorities for the central government around innovation, being technology or pharma, biotech, and so on, has been there for a while. So, from our standpoint of view, what we are helping is local clients, but also foreign clients to really select the winners. I think it's quite impressive how the Chinese companies are able not only to be a fast followers, but in some cases setting new standards for incumbents in the U.S. So from my standpoint of view, this is a big story to stay with us, where we're going to see probably Chinese companies, creating new frontiers of innovation rather than being a follower.
You've mentioned Japan twice already in the last 6 or 7 minutes. What do you like about the Japanese story right now? Obviously, the market's doing really well. There are some pro-growth policies from Takaichi-san, the new prime minister. What in particular do you like about Japan?
Well, I have to say, before year-end, I was in Japan, and after 30 years of, I felt for the first time a renewed sense of optimism across the board, and corporates, institutional investor, governments, regulatory bodies looking in a much more positive ways about the future. So I think Japan is the third largest wealth management market in the world in terms of savings. And it's quite clear to me that now that rates are coming up, and there is a new paradigm that is there to stay with us, and I do believe that also there you will see Japanese corporates probably looking to deploy more assets outside Japan, but also a renewed interest from foreign investors into Japan.
Where specifically would you like to grow in Japan, and what kind of hiring? You were talking about maybe 100 new positions here in China. What about Japan? Well,
across the board in our core businesses. I mean, outside Switzerland, I mean, de facto, the three core activities. In wealth management, we have a very successful joint venture with Sumitomo Mitsui Trust Bank, and that is growing, and we want to foster more in the investment bank. Of course, in the investment banking, in ECM and M&A, reinforcing our presence in equities and in research, where we are a leader in generally in Asia, and last but not least, in the asset management business.
Let's talk about the overall integration with Credit Suisse. You mentioned that in this part of the world and in China, that integration pretty much was completed last year. And you've also said to us, I think in September, that the overall integration will be completed by the end of this current calendar first quarter. What are the biggest hurdles to overcome right now? AI IT integration is going to be a big one, but also there's going to be some personnel issues that you have to resolve as you go through that cost cutting.
Yeah, so what we're going to do by the end of this first quarter, we're going to migrate the balance of around 15% of the clients in Switzerland into the UBS platform. At that point in time, all clients globally will be on a UBS system, right, on a UBS platform. Then we're going to start to shut down IT centers, data centers, and de facto in Switzerland we are still we are still maintaining and running two separate IT systems. So shutting down that one will create the synergies, real estate footprint, and to some extent, unfortunately, also some personnel reduction that will continue to stay within what we announced in terms of proactive redundancy. We believe we're going to manage that below 3,000 redundancies between now and the early part of 2027.
And where do we stand? Do you have any kind of update right now what the bank's perspective is on, of course, the too big to fail regulation and some of the proposals from the Swiss government as far as capital requirements?
Well, this is really an important step together with finishing the integration. I think that I just mentioned, the process of completing the integration and finalizing this very big work because, of course, it is also painful because, as I mentioned, we need to go through redundancies. But what we want to set is the scene for growth, to be able to, to hire again and growth. And in that sense, in order to be able to grow, we need a competitive regulatory framework.
Right.
And what we fully understand the necessity of taking the lessons learned from what happened at Credit Suisse. But we believe that the current proposals are not really reflecting what happened at Credit Suisse and are going too far. And therefore, we are contributing in the debate with our views on the matter. But this is now a political process. We hope we're going to get more clarity by the second half of the year.
Second half of the year. Are there compromises that you would potentially accept? And that conditions of doing business, is it a hindrance, obviously, to be still domiciled in Switzerland?
Oh, look, first of all, there is a compromise is usually between two people, negotiating something. We are not in a negotiation. It's a political process, and therefore we need to see what's coming out. As I said, our role right now is to make sure, on behalf of our shareholders, our employees, our clients, and in general to the public, that we contribute our views on the matter. But we are a Swiss bank. We are very proud to be a Swiss bank. We believe that is a differentiating factor. We believe this is good for Switzerland, and we want to continue to operate as a Swiss bank going forward.
So it's not necessarily a compromise, because as you said, that would be a negotiation, right? But are you confident that they will come up and there will be a resolution that will be acceptable to UBS?
I cannot be confident about that. I think that I'm pleased to see that there is a political interest to go deeper and fully understand the details of this. It's very important to understand the details of what's going on. So such an important decision cannot be taken out of emotions or by people trying to drive the agenda by fear.
What are your opportunities do you see in the United States? Obviously, your chairman has talked to Scott Prasser, and those massive market rumors that was possibly about discussing moving to the United States. But we also know that Mr. Kelleher wants to boost wealth management in the United States. What are the opportunities there?
Well, first of all, I have to say that we are in regular dialogue with many key stakeholders around the world in government's regulatory framework regularly. So there is nothing exceptional when we speak with one or the other officials. But of course, the U.S., together with this region and China, are likely to continue to be two engines of growth. It's very important for us to continue to be competitive and present in the U.S., like we want to continue to be strong in Asia and in our home country, Switzerland.
Sergio Ermotti, thanks so much for your time and having us here at the GCC 2026. We look forward to future cooperation with you. All right, Avril, we're going to send it back to you. That is UBS Group CEO Sergio Ermotti here at the UBS Greater China Conference.
Good stuff, Steve. Thanks very much. We have more ahead from the UBS Greater China Conference in the next hour. The bank's head of China Global Markets, Thomas Fang, will join us live on The China Show. Plus, catch exclusive conversations with former Philadelphia Fed President Patrick Harker and Baidu CFO Henry He. In the meantime, we have breaking news crossing the terminal. This is related to SK Hynix, of course, the maker of high bandwidth memory and a key supplier for NVIDIA. And we are hearing how it is looking to build an advanced packaging fab in Cheongju, South Korea. It'll be planning to spend 19 trillion won on this. This is, of course, significant because for the moment, the majority of its products at its back-end facilities are being packaged in South Korea, in China as well. So something we're watching in the session with the chip stocks looking quite flat, erasing some of the earlier gains, Paul.
Just want to get you across a Bloomberg scoop coming out of China as well. It's understood that China is examining Jane Street, scrutinizing how Jane Street Group and other foreign firms participate in the $859 billion ETF fund market there. It's seeking information on activities carried out with brokers. This is according to people familiar with the matter. And, of course, Jane Street's already fighting market manipulation allegations in India. This is being denied by Jane Street, but now China taking an interest in how Jane Street and other foreign firms take part in those ETF markets. More ahead on the Asia Trade. This is Bloomberg.
One of the things that Chair Powell said in his remarks was he highlighted the importance of independence. And I agree fully with that.
New York Fed President John Williams there speaking at a Council on Foreign Relations event in New York. And, of course, it's been an interesting 24 hours when it comes to the Fed. Of course, the Department of Justice subpoenaing documents at the Federal Reserve. This is over Jay Powell's handling of a renovation at the Federal Reserve. Jay Powell came out swinging against that. U.S. assets went on a little bit of an adventure. We've now got the 10-year yield, though, pulling back from hitting 4.19. It's now back at 4.17. S&P futures looking a little bit softer after recovering from some initial selling in the early session in the U.S. The dollar weaker as well, although rebounding, and that was a beneficiary for gold. Now, let's talk about President Trump now facing some rare opposition from key Republican lawmakers as federal prosecutors open that investigation into Fed Chair Jerome Powell. Digital politics editor Romy Varghese joins us now for more. So, interesting this, another step in political involvement in the Federal Reserve's business. But could this probe potentially end up being bad news for President Trump?
Indeed, this investigation has the potential for creating unintended consequences for Trump and his supporters. I mean, first of all, we have a key Republican whose support is needed to get Trump's nominees through to the Fed, saying he's going to block the nominees until this is resolved. And also the fact that Powell had such a forceful response to this. So it's the first time that he explicitly accused the president of doing a power grab. I mean, that suggests that even when his term as chair is up in May, he might stick around. He can stay until early 2028 if, as some people say, he's being so forceful. Maybe he's saying, well, you're not going to get rid of me that easily. I'm going to stick around. And Powell sticking around could mean opposition for whoever Trump wants as Fed chair.
Romy, what about the financial market reaction? There seems to be some consternation, but that eased off towards the end of the session.
I think the fact that Powell had such a forceful response kind of tempered the hit to Treasury yields. But we have big bond firms like PIMCO, PGIM, DWS saying that any threat, such a sustained threat to Fed independence, can inject stability into the markets, and that will just keep Treasury yields higher than they should be, which is not what Trump and his administration want.
Romy, thanks so much. Bloomberg Digital Politics Editor Romy Varghese. Let's take a look at how Japan assets are faring as well. We are, of course, watching how the Takaichi trade is playing out amid speculation of an early election. The beneficiaries for the moment in early goings, electronics names, auto stocks, the banks also doing well. There is that pressure coming through on the Japanese yen, but that seems to have been mitigated somewhat from verbal intervention following comments from the finance chief. Overall, the weaker yen is supporting export-related stocks in Japan. We are watching very closely the long end of things in Japan, where the 30-year yield has now popped even higher, and there is some talk about how there needs to be a bit of BOJ intervention. They might be the only ones that could be shoring up the market, although we know how the central bank has been taking its foot off the stimulus pedal overall. Something else to watch as well, a couple of weeks we have a 40-year debt auction. That could be something for markets to navigate. This is Bloomberg. We're counting down to the open of China markets. Ahead of that, take a look at this chart and it will show you how Chinese stocks have more or less been ripping higher on this record turnover. And there is some sense that the rally has been driven by Chinese hardware-related names. But when it comes to software, given the government intervention, so to speak, that can also potentially be seen as a way in which the delivery wars can be capped. Maybe that's a driver for the mega caps in China. Take a look at how Hang Seng futures are faring, 1.5%. Already experienced a really good day just a day ago. So investors overall, they've been increasingly betting that the Chinese market's valuation-driven rally could morph this year into a more sustainable earnings-led advance. That's something to keep in mind. Let's bring in our senior Asia equities reporter, Abhishek Vishnoy. So, Abhi, we've been seeing onshore doing well, offshore also not to be left behind. What is your sense of the drivers, and does this have legs?
It definitely has legs. Last year, the run-up that we have seen both onshore and offshore equities have largely been driven by valuation expansion. Earnings growth was limited to about 3% as per our calculations. I mean, while the numbers are still trickling in for 2025. But if you talk about a year from now, the estimates suggest that earnings would grow by about 15-16%, which are pretty decent when you compare to other major economies in the region like India and Japan. And that sort of supports the bottom-up targets, stock targets, implying about 22% odd upside on MSCI China. So this would be an earnings-led advance, which means it makes it more durable, which may work out to be less volatile, so less fears of any big or sudden drawdowns there, because earnings are coming in. You're trading on back of profit, not just profit expectations. And more recently, if you see, we had just summed up something from local media where about 108 companies, onshore companies, had come out with their earnings. The growth there was better than expected, as per some circles. We talked to a bunch of fund managers, and they were looking to increase exposure to Chinese equities, both onshore and offshore in this context, cutting their underweight position. So, valuation, even after last year's rally, remain very cheap. The AI excitement is there, but it's going to not boost the valuation as much, but it is going to boost the earnings. And obviously, non-AI earnings are also coming in. So, to me, from our reporting, it looks like this is more durable. It might be a precursor to the slower bull market that Shanghai wanted and is now going to get.
Abhishek, in terms of tech excitement, another day, another semiconductor listing in Hong Kong. This time it's GigaDevice. Can you tell us a little bit about this listing, what the grey market pricing is telling us?
Yeah, so the grey market price is actually giving us a bump of about 39-40% odd. More importantly, it again underscores the interest in China's AI related stocks. This is the second such listing in as many days. It is still commanding a discount versus its onshore listing, and when you compare that with other similar listings onshore and offshore, the discount is pretty wide, pretty higher versus its other peers. But again, it shows that this has become, a venue to unlock value. Like, for example, in any other scenario of a market, if big shareholders are selling stocks or listing in other venues, they are essentially, or promoters are exiting, controlling shareholders are paring stake. That might look like a signal which might be weak for the market, but considering where China is, the valuations, the AI setup of the world, this actually bodes well and unlocks a lot more value for Chinese AI stocks.
Are we also seeing the unlocking of the narrative once again, given Sell America was revived, the extent in which that's fueling demand for Chinese stocks as well in the mid to longer term?
Yeah, it would work out. The Sell America trade, the last time, my colleague Ruth Carson had written about that story, I think America's weighting in the MSCI World Index was nearly at all-time high. It went down from there. But given the rally in Mag 7, the weighting has again come back to about 72%, probably near all-time high in the MSCI World Index when you look at the developed market. So, the setup is pretty right. There are risks coming on the horizon with, what Trump has done in Venezuela and wider Latin America, and now with Federal Reserve's independence, and therefore there would be, it's expected that there would be some pairing of exposure, and that exposure would find, its way to China. This is the second largest economy in the world. On purchasing power parity, it is probably the biggest, right? There are arguments on both sides. So naturally, if you are, taking something away from a market which is trading at 22 times, which is stretched, and where the narrative seems to be all over the place in terms of policy making, you're going to be attracted to a market which is trading at about 12 times on MSCI China. So almost half the valuation, better growth prospects, and definitely a lot of roles in portfolio. So China is not just a diversified in portfolio now. China is a bet on growth. China is a bet on AI. So there's so much more market cap to be created. So, we are very excited. Investors are very excited when they're, talking about this aspect that the Sell America trade is getting revived and how some of that money would find, its way into Chinese equities.
All right, senior Asia equities reporter Abhishek Vishnoi there. Well, Bloomberg's been told that the Trump administration is closing in on a tariff agreement with Taiwan, with negotiations entering the final stages. Let's bring in managing editor Jill Desis with more. So, Jill, this has been a long time coming. What are the final sticking points, and do we know when we might see a deal get sealed?
Yes, that's right, Paul. Well, it does seem like these two are in pretty final negotiations at this point. The New York Times is actually reporting that that effective tariff rate might be lowered from 20% to 15%. That would put, as an economy, Taiwan in line with a lot of other North Asia economies, such as Korea and Japan. So, kind of bringing that into parity there. The other thing that is pretty central to this, it appears, is the likelihood that TSMC will have to up its investments in the United States as a component of this deal, so that they could see their manufacturing presence significantly ramped up in Arizona. That's where, as you may recall, they already have a significant manufacturing plant. We'll point out that at this point, TSMC already has existing investments pledged of a total of, I think, $165 billion worth in the United States. So what it does seem like are the components of this potential deal here are, again, that lowering that tariff rate to something that would be more in line with what you're seeing elsewhere in North Asia, and then also seeing a significant investment in the United States. Again, that's kind of on par with what the Trump administration has really looked for out of a lot of other economies from these types of deals.
What about the potential for a U.S.-India tariff deal?
Yes, Avril, I think this one's a little bit trickier. I'm sure, as you know, the India-United States relationship over the past year has taken quite a downturn in terms of diplomatic relations here, with the United States slapping tariffs of 50%, largely because of their accusations over India's continued purchases of Russian oil. Now, all that being said, we've heard, some recent statements from the new U.S. ambassador to India, Sergio, making some promising statements about how, friends may disagree, but ultimately they may get somewhere in the end. He made the point that, as a particularly large economy, large nation, it's quite difficult to get things over the line with India, but he did seem somewhat like he was, there was some promise there in terms of something actually happening. I will point out that because that one in particular has dragged on for just so long, remember, almost a year ago, we were thinking that India may be one of the first nations to actually sign a trade deal with the United States. Obviously, that hasn't happened. And at this point, we've actually heard quite a bit of trepidation from some Indian exporters that are, quite wary of, getting something, fairly soon just because of how much it may affect orders into the middle of this year. So we'll have to see if that ultimately results in something maybe, either this month or next.
Jill, thanks so much. Our managing editor, Jill Desis. Now, we are also watching South Korea, and the President Lee Jae-myung and the Japanese Prime Minister Sanae Takaichi, they're set to meet today as they work to improve ties strained by wartime history, territorial disputes. Bloomberg's East Asia government editor, John Herskovitz, joins us now for more. John, what's at stake in this meeting, and how does China factor in with Lee Jae-myung meeting with the Chinese president not so long ago?
Sure. For Lee Jae-myung, this is a chance to show that he can balance South Korea's geopolitical and economic interests between two key partners, Japan and China, without alienating the other. China is watching this summit closely. It courted Lee Jae-myung last week. It brought up historical issues. It's looking to put pressure on Japan for what it sees as incendiary comments from Takaichi regarding Taiwan. For Takaichi, she is looking at it. She could be facing a snap election, something that's been rumored in Japanese political circles, and wants to come away from this summit looking stronger. She wants to keep relations with South Korea on an even keel and try to get South Korea's support as it faces pressure, as Japan faces pressure from China over trade. So in the South Koreans often like to say that South Korea is the shrimp between two whales, Japan and China, and it's facing pressure from both. Lee Jae-myung has to balance the two, and Takaichi has to come out of this showing that she can keep ties with South Korea strong and also strong enough that she can go into the general election looking like a leader.
Yeah, so a balancing act for President Lee. What's on the agenda for the summit?
There are a few things. They're going to look at supply chains, South Korea's ascension into a regional trading partnership, CPTPP, and security concerns. North Korea is one of them, and trying to further these interests. So I don't think we're going to get a lot of symbolism. I don't think there's a press conference on the cards, but there will be a joint statement coming out of it. So these are the key things that they're looking at for it.
John, what else are we hearing in terms of what might come out in terms of concrete action between the two sides for the meeting?
In terms of actual concrete action, I think we're going to see a statement, but it's the main thing is the dynamics of this are going to be closely scrutinized by the key partners, China and the U.S. For China, the stakes are with the Japan friction. For the U.S. has looked at Japan as trying to secure supply chains that are independent of China. The two key partners in Asia for that are South Korea and Japan. So they're going to see how the pressure on China through its two key partners are going to be played out. And also there's the security concern. South Korea and Japan are the two key countries for hosting U.S. troops in the region. They would be essential for any response to China vis-a-vis Taiwan, and also for coordinating the trilateral cooperation among Japan, South Korea, and the U.S. has gone rather strongly over the past few years. So trying to keep this in order is something that the U.S. will be looking at as the meeting goes on.
John, thank you so much. Our Bloomberg East Asia government editor, John Herskovitz. We have more ahead on the Asia trade. This is Bloomberg.
I've said repeatedly that our government's priority is to promote unity and social cohesion. And this is what Australia needs: to heal, to learn, to come together in a spirit of national unity, and to go forward knowing that just like people who gathered that night on Bondi Beach were committing to, that light will prevail over darkness. It's clear to me that a Royal Commission is essential to achieving this.
That's Australian Prime Minister Anthony Albanese speaking a few days ago, bowing to widespread pressure to call a royal commission into the country's worst terrorist attack, which saw gunmen kill 15 people at a Hanukkah celebration at Sydney's Bondi Beach. Now, the inquiry will be led by former High Court Justice Virginia Bell, who served on Australia's top court from 2009 to 2021. Albanese says the commission will investigate the nature and prevalence of anti-Semitism in Australia, as well as the circumstances surrounding the Bondi attack. Justice Bell is expected to make recommendations and issue a report before December 14, which will mark 1 year since the massacre. Now, Australia's Parliament will also reconvene 2 weeks early to debate laws on hate crimes and gun ownership. Albanese says legislators will return next Monday to pass new legislation and offer condolences to the victims. Well, joining us now is Scott Prasser, independent researcher and the author of Royal Commissions and Public Inquiries in Australia. He's also a former senior advisor to 3 federal cabinet ministers. Scott, thanks so much for joining us today. And I just want to start, if I can, with those remarks from the Prime Minister last week. There was a reversal from his earlier position to not hold a royal commission. Do you feel going ahead was the right decision, and what do you think that this royal commission is going to achieve?
I think it's the right decision to go ahead with the royal commission. I think the government's mistake was to delay for 3 weeks and to deny for 3 weeks that there needed to be a royal commission. So the Prime Minister and every minister, Labor minister, said there was no need for a royal commission. So he missed an opportunity to do this properly from the word go, and as has happened in some other royal commissions. So what this royal commission is going to achieve, well, it's going to depend very much on what the chair, Virginia Bell, how she runs that royal commission. And it's really important that the royal commission does not seem to be avoiding important issues that have the underlying causes of this problem, as well as understanding what happened on that terrible day. So I think the government could have run this much differently. Also, they've created a lot of confusion because the government set up a non-royal commission under Dennis Richardson to look at the security issues. So this is a doubt now where that fits in, this new royal commission. There's a big difference between a non-statutory inquiry and a royal commission which has real powers.
Now, there were, while supporters outnumbered detractors in terms of holding a royal commission, I mean, some of the criticisms against holding one was, like, look, this is going to devolve into arguments over definitions. It's going to, what defines anti-Semitism, also the risk that it could become dominated by the whole Israel-Palestine debate. So can you talk to us about those risks and the job that Justice Bell is going to have to make sure that this royal commission retains its focus?
Well, the government, in the terms of reference issued by the Governor-General, have used the United Nations terms of anti-Semitism, so that's easily overcome. The way the Royal Commission operates, every Royal Commission is different. There's no sort of handbook on how to run a Royal Commission. So every Royal Commission will depend on how the chair runs that Royal Commission. And Royal Commissions have investigated in the past very sensitive issues, child sexual abuse, people with disability being abused, and so on, and allegations of corruption against government and trade unions and so on. So they can be run in a way, and it's up to the chair that it doesn't become a witch hunt on certain groups, and it doesn't give too much voice to people who have got different viewpoints on this matter. But it's got to be seen to be Royal Commissions are public hearings, are basically very public processes, which is their great virtue. But Royal Commissions have had a record of doing these sort of things properly. Again, it depends very much on how the chair runs it. So there are going to be some confidential issues which can be handled in camera, which Royal Commissions do from time to time. So I think those problems can be overcome. And I think if we didn't have a Royal Commission, there'd be continual doubt about what the government is hiding or why the government doesn't want to get at the bottom of this matter. Royal Commissions are about seeking the truth. That's what they're on about.
Just very quickly, Scott, are you optimistic that this Royal Commission will mean meaningful change?
Well, I think it's the first step. I mean, a Royal Commission only makes recommendations. They can't enforce those recommendations. They are, after all, human constructs. They don't always get everything right. There's been examples of Royal Commissions sometimes missing points or overemphasising points. So it's going to be, so at the end of the day, it's up to the government. The test for every Royal Commission is how it's run, how well its evidence is, and then what happens to the recommendations and how those recommendations are interpreted. And that's up to the government of the day. So come December this year, when the Royal Commission hopefully, possibly delivers its report, it's back on the government's desk, okay? And it's up to the government how it responds to that matter. Also, during the course of this inquiry, it's quite possible that the Royal Commissioner will see things or find out things and may want extended terms of reference to look at particular matters, or may want even extensions of time. So that's one of the, it's a bit of a risky business appointing a Royal Commission for any government, because sometimes you never quite know where it will end up or what it will recommend. Sometimes they do things which are not expected. So that's the trick of these Royal Commissions. They are independent bodies and they can wander and go wherever they want to.
All right, Scott Prasser, we are out of time, but thanks so much for joining us today. Scott Prasser is independent researcher and author of Royal Commissions and Public Inquiries in Australia. We have more ahead on Australia Ahead every Tuesday, 11:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. Also, you can tune into the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's role in global business. You can find it on Apple, Spotify, or Bloomberg.com. More ahead on the Asia Trade. This is Bloomberg.
Time to revisit how Japan assets are faring in the early parts of the session. Of course, again, it's been about the speculation of an early election from Takaichi. We are seeing the Nikkei 225 going gangbusters, 3% higher. I think it's on track for a record closing high. And of course, given how the weak yen has been playing into some of the export-related stocks, we're tracking autos. We're tracking banks as well, though, given how yields are faring. Take a look at the JGB 10-year, although the concerns are perhaps more focused on the longer end of things, given how that pro-growth, pro-stimulus approach might be gaining further confidence following on from potential election out of Japan, Paul.
We're hearing a little bit more from the New York Fed's John Williams as well. He is backing Chair Powell's calls for Fed independence. This is after the events of 24 hours ago when it was announced that the DOJ had subpoenaed Jay Powell over the renovation at the Federal Reserve, widely as anticipated, interpreted as an attempt to curb independence. Williams saying markets don't want to get ahead of that Trump-Powell news, and the FOMC isn't under significant pressure to adjust rates, and markets taking all of this in their stride at the moment. S&P futures off by about 1/5%. All right, that is it from the Asia Trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show is next. This is Bloomberg.